Do Forex brokers really trade against you or cheat on their clients? Forex trading can be a lucrative opportunity, but one of the most debated topics is whether brokers trade against their clients or engage in unethical practices. Many traders are cautious because there have been numerous examples of brokers manipulating trades or exploiting their clients' lack of knowledge. To really understand this issue, it's important to explore how brokers operate and look at real-world scenarios where things went wrong. A Forex broker is essentially the middleman that facilitates trades between you and the market. They offer platforms, tools, and access to currency pairs. However, their business models differ. For instance, market makers create their own market by acting as the counterparty to your trades. Imagine you're buying USD at a specific price. In this case, the broker might be the one selling it to you. This isn't inherently bad, but it can lead to a conflict of interest because the broker profits when you lose. There have been reports of traders experiencing issues with market makers who artificially widened spreads or manipulated prices. For example, in 2017, a group of traders accused a broker of increasing spreads during non-volatile market hours to eat into their profits. On the other hand, ECN or STP brokers connect you directly to liquidity providers. These brokers don't take the opposite side of your trades and make money from commissions or spreads, not your losses. For instance, brokers like Pepperstone or IC Markets use the ECN model and are often favored by traders for their transparency. However, even ECN brokers aren't foolproof. A trader once shared an experience where an ECN broker failed to process a withdrawal, claiming technical errors, which turned out to be an internal delay tactic. While this wasn't necessarily cheating, it's a reminder that even transparent brokers can sometimes falter. Market makers often face criticism for their practices, especially when it comes to stop-loss hunting. For example, let's say you set a stop-loss for GBP, USD at 1.2500, but the broker's platform suddenly shows a spike in price that triggers your stop-loss. The market may not have actually hit that level, but the broker manipulates their system to close your position, ensuring you incur a loss. A notable case involved a trader in 2019 who recorded evidence of their broker's platform showing a price that was inconsistent with market data from third-party sources. Upon investigation, it was revealed the broker had been altering price feeds to target stop-loss levels. Another common issue is slippage, where a trade gets executed at a price different from what you intended. While slippage can occur naturally during periods of high volatility, some brokers abuse this by intentionally delaying execution to give traders a worse price. For instance, during the Swiss franc crisis in 2015, several brokers were accused of manipulating execution times to their advantage. In one case, a trader complained that their broker executed a trade at a price far worse than the market rate, resulting in unnecessary losses. Unregulated brokers are a particularly dangerous trap. For example, a notorious scam in 2020 involved a broker that promised guaranteed profits of 30% per month. Thousands of traders signed up, only to find that their funds were frozen when they tried to withdraw their earnings. The company disappeared overnight, leaving clients with no recourse. Stories like this highlight the importance of choosing a regulated broker. Organizations like the FCA, Financial Conduct Authority, in the UK, or ASIC, Australian Securities and Investments Commission, in Australia enforce strict guidelines that prevent such scams. Even among regulated brokers, traders must watch for unfair practices. In 2015, a high-profile broker was fined millions of dollars for deliberately widening spreads and requoting trades during significant news events. This practice allowed the broker to take advantage of traders who were trying to capitalize on quick market movements. Regulators uncovered this misconduct after complaints poured in from clients who couldn't execute trades at the prices they were quoted. Fortunately, there are ways to protect yourself. One key step is testing a broker with a small deposit before committing larger sums. For example, a trader who deposited $100 with a lesser-known broker noticed execution delays and unresponsive customer support. They withdrew their funds immediately, avoiding a potential scam. This kind of small-scale testing can save you from bigger losses later. Another trader shared a positive experience with a regulated broker that provided clear withdrawal policies and rapid customer support when a technical issue arose. These kinds of interactions build trust. Education is another critical factor. A trader shared how, early in their career, they misunderstood leverage and overexposed their account, losing most of their capital. They initially blamed the broker but later realized the loss was due to their own lack of understanding. After learning more about risk management and market dynamics, they switched to an ECN broker and began trading with better results. This underscores the importance of understanding trading models and strategies. Regulators also play a crucial role in protecting traders. For example, the CFTC, Commodity Futures Trading Commission, in the U.S. took action against an unregistered broker in 2018 that had been stealing funds from clients and falsifying trading records. This case resulted in the broker's assets being seized and returned to victims. Stories like this highlight how important regulation is in holding unethical brokers accountable. While there are risks in Forex trading, not all brokers are out to cheat you. Many, like IC Markets or OANDA, operate transparently under strict regulations. They provide fair execution and reasonable fees, helping traders focus on improving their skills rather than worrying about being scammed. However, the key takeaway is vigilance. If a broker makes unrealistic promises or uses shady tactics like unclear withdrawal policies, excessive bonuses, or hidden fees, it's time to walk away. Ultimately, Forex trading requires both knowledge and caution. With examples of unethical practices in mind, it's clear that staying informed and choosing a trustworthy broker can make all the difference. Whether you're just starting out or are a seasoned trader, always remember to research thoroughly and trust your instincts when something seems off.